Hi, everyone. Welcome to Refinitiv LPC's Middle Market Weekly Videocast. I'm Diquez, Contributor Relations Manager, and I'm joined today by my colleague, Dave Puchowsk. Hi, Dave.
Hi, Dina.
For those of you who are listening to this weekly videocast for the first time, we recently started putting this together as a way to provide you with some market color that complements the data.
Yeah, so we'll highlight a few charts here, but there's a lot more in the PowerPoint deck posted to Loan Connector, so definitely check that out too.
Recently, we did a survey and have been speaking to many middle market lenders throughout this crisis, and we thought that this week it would be good if we could provide you with an outlook on the middle market. So let's get started with the economic outlook. We asked this question in the survey. With businesses starting to open back up, is lenders' optimism on an economic recovery growing in second half 2020? You can see in the chart on the left that the majority of respondents expect an uneven recovery in the second half, where we will see some businesses rebounding quickly, while others are going to continue to struggle. While the equity markets rally suggests there is a lot of optimism, a lot of it is riding on when a vaccine becomes available, and there really is a disconnect with what is going on in Main Street. In the chart on the right, we see how the S&P has rallied, but if you look at consumer confidence, we see a dramatic drop. Lenders expect things to change once the June 30th quarterly financials are available. They expect more pessimism, as there are really many challenges ahead. The fact really is that business models that were thought to be resilient are going to change materially going forward. Consumers are going through a lot of changes. I mean, most of us are working from home, and we all have different risk tolerance. Do you go back to the salon? Do you go back to a show? Are you willing to go to a restaurant? Or are you willing to travel? And this is really going to have a lot of impact on many sectors. Lenders also fear that once the fiscal stimulus wears off, the economy could take another leg down. But I'd like to end on a positive note on this. We did hear from lenders that a lot of the companies have right-sized the expense side of their businesses. So if they can operate at these levels, once they see some revenues, EBITDA will probably increase. Now on to our next survey question.
So we asked, what percent of issuers do you expect will miss principal and interest payments at June 30th? And you see there the majority of respondents chose between 1 and 10%. Now, the question lenders raise is which companies won't be able to pay and which ones might choose not to pay. Some lenders foresee that from June to August, there will be covenant events and other defaults to deal with, while others say that 2Q20 could be okay. Companies have been living with this for the last 90 days and have taken measures to deal with the situation. But then what happens in 3Q and 4Q? Maybe some companies can't reopen. And there are also too many factors in play in the second half of the year, like a possible resurgence of the virus or political implications with it being an election year. But there were optimistic responses too. A few lenders said they don't expect to see any missed payments because they've already worked through the ones that they know will miss them.
I also wanted to point out something that I found very interesting. And for second quarter, it looks like things have changed a lot. When all this started, it felt like the sky was falling. Sales potentially would be down 60 to 80%. But if you fast forward to May, where we are right now, it seems that sales are only down around 20%. So people are definitely more positive. However, a meaningful share of loans will still go bad as the year progresses, and lenders have told us that recoveries are expected to be lower than in the prior cycle. There really are a lot of sectors that will be hurt bad, and loose stocks will get lenders to the table a lot later. Our next two questions were about pipeline and hold levels. You can see the answers in these two charts. Here we see that most lenders are open for business, but are very cautious, and hold levels have declined dramatically this year. There are definitely some signs that the market is reopening, and pipelines have gone from anemic in March to a few deals now and then. However, there's very limited new money opportunities. While they're looking to put money to work, lenders are being very selective and picking their spots carefully. They're really trying to figure out which businesses are not seeing a total demand reset and are looking only at businesses that have visibility. A few of them are willing to put money to work on the underwriting side, but only for COVID-proof businesses or those that are not massively impacted. However, this is tough. It's very hard to find co-underwriting partners, and also flex language pushes sponsors to the direct lending market.
So as you see, there are many challenges in today's market, and looking at the hold levels, we see that everyone's hold levels are down. Not one lender chose a hold level of 200 million and above in the survey, whereas last year 22% could hold that level. Lastly, given all the challenges and unknowns, we wanted to know what the current environment is for fundraising in the middle market. Now, we didn't ask this question in the survey, but have had some conversations with lenders on this. We also track fundraising, and you can see 2020 numbers and how far off they are from 2019's total. Lenders did tell us that LPs are open for business and need to deploy capital, but are being very selective and will generally only invest in existing funds and with existing managers. Making it harder is that these investors can play in the investment grade market, which is looking a lot more attractive now, so why dip down? One challenge for new funds is that LPs won't invest in them until they can have a face-to-face meeting. Also, LPs have become a lot more sophisticated and are looking at the backbone of institutions, going through their portfolios and determining winners and losers, and are comping to all their other private credit investments. Now, some good news that we heard is that the calendar is filling up, and some LPs that were focusing on distressed situations are slowly moving back to normal, investing sooner than we expected.
Thank you, Dave, for ending that on a positive note, and thank you for joining me today. Thanks, everyone, also for listening in. In the Full Middle Market Weekly Report, you will find a lot more insight from our conversations with lenders and some very interesting data. Thanks again, everybody, and stay safe.